See how this goes. We are launching a poll, job market survey. How do you feel about the state of the job market? Pessimistic, neutral, or positive? Let's see what people have to say. Alrighty. I haven't done a live stream in a while, so we'll see how this goes. Let's see if it is even live over there. Okay, I do see us live. Okay, great. All right, the chat is on. We will get this going. Okay, we have one person who feels positive. 50-50 right now with just 3 folks in here. We'll wait for more folks to get in here. And then I will go ahead and post this into the group. How is Asia?
Hot. Very hot. Anyone who doesn't believe in climate change should just
What's
fly
that?
to Asia right now.
Yeah.
Stupid hot.
Hmm.
Should not be this hot in like September, but it is what it is.
Yeah.
Food is good. I'm still adjusting
Yep.
for, I guess, jet lag, or hopefully it's nothing.
Hey, how's it going, Dr. White?
Hey, Albert. Hey, Colin. How are you guys doing?
Hello, hello.
Colin, how are you?
I am adjusting for jet lag.
Ah. Oh,
Adjusting.
are you back from Taiwan?
Yeah, I am. It's
This is, how was it?
hot. I was just saying, anyone who doesn't believe in climate change can go to Asia and see what it's like.
Yeah.
Ah, yes.
Other than that, food is
Yes.
good. People are nice.
Night markets?
Night markets are great. I'll
They
always
didn't,
enjoy my time there.
from my trip last October, there's no signs that say, most wanted or anything, right? And there's nothing like with my face on it that's like, do not talk to this man. This man is wanted for various crimes.
Wanted for spreading terrible positive news about econ.
How dare you give people hope, Riley? No, no,
Okay.
it's true. That's a terrible, but it's also not good. And this month is worse than last month. So in the end, everything is
Mm,
Colin reverting. So that's what we have.
Colin
They're
reverted.
they're they're lowering rates, which means it's gonna be good, right?
Ah,
Although there is definitely a caveat to that one because even though interest the Fed funds rate went down, it sounds like mortgage rates have continued to rise a little bit after the fact. So should be interesting. Yeah.
I know we're going to talk about that right up, actually, and that's the fun thing. It's like they made a fool of me because I was on the news the other day, and they were like, "Well, Riley, about these now that rates are coming down, is it going to get cheaper for people?" And I'm like, "Yeah, the tendency for markets is that when this happens, it does get cheaper." And then, of course, the 10-year Treasury bond, which tracks like mortgage yields, for instance, has been going up
Yeah.
all week, and it's been just I got an explanation why, but we'll see if it's legit. But man, it's a ride out there right now.
It is certainly a ride out there. Yeah. And so we have a poll up currently as well. I'm going to actually make you both co-hosts before we start this
Ooh.
whole thing. It's our monthly poll where we ask about the job market survey from those who are here in the room with us, whether they feel positive, negative, or neutral, pessimistic, neutral, or positive about the state of the economy. And it's actually straight down the middle even. 29% pessimistic, 29% neutral, 43% positive. So go figure. Go figure. Go figure.
We need some more
Yeah.
votes.
Needs more votes.
Yes,
Yes.
there's some
Needs more votes.
what kind of
Um,
statistical significance is this survey? It's just that's your standard deviation, plus or minus.
yeah. Oh, I don't know. I did not do well in stats in college, so I can't really say that. Uh, yeah, yeah. Well, I mean, I feel like a big weight has been lifted off our shoulders with this first rate cut because we're expecting another one in December. So maybe we don't feel quite gaslit, but maybe we should feel gaslit to some effect. We'll see. Um, but yes, welcome to everyone coming in. We have a poll for everyone to take before we begin here. We're going to wait a few more minutes before we start. If you have your questions, use the Q&A feature. If you have things to say, use the chat feature. And if you are a spammer with something to say, you will soon be kicked out once you reveal yourself. So um, do not hesitate to reveal yourself so that I can make this chat room cleaner.
That was fun last time, wasn't it? We had a
Gosh,
it was
yeah.
unexpected. I wasn't
We
expecting.
haven't had one of those in a while, right?
Yeah. Those guys are normally on my crypto presentations, but not today. Those are
Yeah,
fun.
not today.
That's
Matt's like, ha. Yeah, so but yeah, hopefully everyone's doing a little bit better this month. I don't know, neutral. All right, neutral's 45. We have a perfect bell curve, if you could say that, I guess, right? 27% pessimistic, 25% pessimistic, 50% neutral, 25% positive.
uh,
The
yeah,
bell curve.
that's the kind of institutional ennui I expect from Albert's list. That's the kind of cynicism and built-in, that's great. I love it. That's
Use ennui in a sentence, right?
I know. My whole life is a series of varying ennui. It's a survival tactic in academic
Yeah.
administration, let me tell you. I'm pouring myself tea, but it might as well be something stronger.
My
Oh,
favorite rare word is defenestration or
oh
defenestrate.
yes. That's right. Ever since Prague, though, it's been overused. I'm telling you, the whole time. It's been, oh
So
God.
actually, speaking
That's
of
a 30 years
overused
war joke,
words,
in case you guys were.
what's that? Have you used the word delve in your research papers, as the
Yes.
statistics have shown since ChatGPT came into vogue?
Oh gosh, I absolutely have. And that's hilarious that you point that out because I literally just wrote, I'm giving a research presentation tomorrow, and
Yeah,
Delve is on my slides. Thanks.
delve
Thanks,
is on
Albert.
your slide. You've been called out.
I've been, you're seeing me. I'm a little, I'm wary. This is why it's Albert's list. This is why he knows things about all of us
I
that we
mean,
can't control.
you have, the most
50,000 people.
intelligent,
He knows everybody.
geekiest folks here because they're willing to spend their Thursday evening learning about economics and the state of the market. And, it's always fantastic. So I'm going to go ahead and hit record. You're able to share your screen, right? Just before I do that.
I can. Here we go.
Okay, perfect.
As you can see, we're here on Sort's list.
Oh, I will on Alidsort. Okay, Lord Alidsort. I like that. I like that. Oh, I think you have to make it your regular screen size so
Oh,
we
yeah,
can
that's
all see
right.
what
It
you're
gets
doing.
weird, doesn't it? I'm sorry. Some
Yeah,
of them
no
don't.
worries.
I just gave
There we go.
a different lecture. Okay, we'll keep it this way. Got to see the previews.
All
Got to
good.
see the
All right,
preview.
I will do the record. All right, happy Thursday, September 26th, 2024, everybody. Hope you are well wherever you may be in this world, and welcome to the August 2024 Jobs Report and Inflation Updates. We're also live streaming this from YouTube for the very first time, so if anyone's watching on YouTube or after the fact, hello and welcome to our monthly jobs report, where I'm just doing some testing to see what it seems like when it's out there on YouTube. So if you're here for the first time, if you've never been here before, we'd like to welcome you. This is our monthly webinar where we talk about the state of the job market and where things have been and where things are headed and all the trends in between, including this last interest rate cut that we saw just late last week. Joining us per usual is Dr. Riley White, economics professor at the University of New Mexico, an associate dean and associate professor of finance. Actually, I should say that because I should be accurate. And he's here to give us the trends, the news, and the views, and to answer your burning questions that you have on a monthly basis in case you're wondering where the job market and everything else with inflation is headed. So for all of those of you, enter your questions into the webinar chat or the Q&A, and we will address them in due time. In the meantime, this is also being recorded too, and you'll find it on our YouTube channel where you can watch the replay, which I frequently do because I sometimes just enjoy listening to all the news that has to come. So without further ado, Dr. White, I'm going to hand it over to you. Thank you for joining us and coming back as you do on a monthly basis.
Thank you, Albert. It is a pleasure to be here. You guys are my favorite audience. It is such an honor to talk. Thank you so much for such a wonderful introduction as always. This is great. It's a rodeo, Marcia. Yeehaw! We're gonna rope things in, and we're gonna rope in inflation and see what the jobs market does. As you can see, AI had some trouble generating my front picture today, so Alan Sort's list. Another day for this, but this is good. What a beautiful day! Is the sun rising? Is the sun setting? Obviously, maybe it appears if it's setting to the south. It's a very strange anomaly. I don't know. We're somewhere in Marin County here, and you can see the happy agricultural workers on the bottom left. All of them have 5 master's degrees or more. So let's talk a little bit about where we are today and engage a little bit about where we're going to go. So we got some news about the Fed I want to talk about. And if you've got any questions throughout this, comments or insults, send them my way, pop them right into the chat window. It is great to hear from you all and make things happen. No such thing as a silly question. We have some really excellent intellectual questions. Albert sent me a pre-list of questions, which was awesome as always, and I loved reading them. They brought me great joy. And we're going to talk a little bit about some of those things, and I'll weave them in. And then more likely than not, yes, Albert insults. We can insult all the way down. Just keep it below the crypto standard of the last time. But we'll do it this way. So we had a jobs report this August, and it was released in September. And we've got, okay, I didn't vote for you. Tough schnook. I was awarded a sword from someone in, just reaching out of, the Sacramento River. One of the people, we had a disappointing jobs report earlier this month. Disappointing in the sense that it was kind of where we thought it would be. I've seen different spins on this jobs report. Oh, it's not as bad as we thought it was. It was actually not too good. It was slower than it was last month, which is no stellar bargain by any means. And given the level of immigration being a little bit higher than we've had in the last couple years over the previous couple years, it's likely a good jobs report right now. We need to see 250,000 new jobs or above, probably even higher than that, to keep up with immigration in other parts. We only had 142,000 new jobs. Unemployment rose to 4.2%, thus the catalyst for the Fed making their 50-point drop, which we'll talk about in a second. So this is, oh yes, we're going to talk about the spike in part-time jobs in particular, Albert, because not all jobs are created the same. And we're finding that one of the most nefarious parts about looking at the question of aggregate numbers is what's really going on down here, and particularly that spin between full-time jobs and part-time jobs. And we've noticed right now that part-time jobs are on the up and up in a big way. We're going to talk about that later on too. Bright spots. So what's the bright spots? Okay, leisure and hospitality. Here we go, service sector. We're climbing up that ladder. We're making it happen. So if you've got a job in a restaurant, congratulations. That is good. You are solid. You are practiced. You're going to see more growth here because we are back up to where we were before, and there's a labor crisis in this market still. Healthcare and social assistance, a perennial favorite. Healthcare has been the source of just immense investments. It's going to continue to be for demographic purposes. It has been robust. Of pleasing note is construction, when people build stuff that generates economic activity. And that's been very uneven, but it's been on the positive side this year. All of that's good. Some of that is work. Some of that is, leftover from reshoring and manufacturing plans and other things. And this is always a good sign that the economy is still ticking. Government work is up 24,000. That's fair. Now, on the underside of the economy, the deep side of the economy, the less than desirable side of the economy, we're seeing some drops right across the board in manufacturing. Strange to build manufacturing plans for reshoring, but losing manufacturing. Some of this is dollar-based, some of this is trade-based. There's some other factors going on. We've got, despite a large amount of onshore manufacturing growth, we've seen the physical number of people employed in manufacturing drop. So we can say what's actually happening. We're not hiring in the same way we did with regards to manufacturing in plants. And I know a lot of firms are using the ability of available funding to look for things like automation and change the nature of doing things as it pertains to manufacturing jobs. Retail services, again, the pulse of the U.S. economy. 2/3 of our GDP is based off of consumer spending. Spend, more money, 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 less problems. And this has been the case for the last 70 years, basically. But our retail market has been historically robust. But we've seen that pull back now for multiple months in a row. And that's been an interesting sign to say that, hey, maybe consumers are feeling it a little bit and they're feeling a little stressed. We've got information. Oh, gosh. The Bay Area perennial favorite, the source of all of your joy and all of your concern, dropping another 7,000 jobs. Oh my goodness, what is going to happen with this information? Is it down? Is it forever? Are they moving to Austin? Are they moving out of Austin? Is it people in Austin being fired? All three of those things. But in that sense, we also have utilities, mining, and logging also flat. But notice though, as we look at the number of sectors that are increasing jobs and decreasing jobs, we track this perpetually to give kind of a pulse on the economy. It's about 50-50 if we're a little bit more refined in where our industries are looking and the number of industries that are increasing their jobs and the number of ones that are decreasing them. Truly a sign of a moderating economy. So Albert says, can afford to eat still? No, of course not. We're talking ramen only. And even then, not even the real ramen, like the discount with the Big Lots version of whatever ramen is. And then M1 money supply is increasing again. That's true. Should we be worried about it? Yeah, not so much right now. And I think when we lower some rates further, and we're not seeing any sign for an upward tick in inflation right now. And I think some of this consumer spending coming off is still taking off the heat a bit from our money supply. One of the things that happens if we've got too much money growth and not enough places to put it, we get inflation, and that results in higher prices across the board. And so the Federal Reserve controls one interest rate, overnight lending to large banks that they call the discount rate. But this has a ripple effect in all the other rates we have in the economy. So this is something that we follow with great detail, which is why when Jerome Powell came out and nobly said that we were going to cut rates and did so to 50 basis points, it was something that was met with wild enthusiasm and abandoned in financial markets. But it's a really interesting place. Other rates in the economy are publicly traded, and we'll get into some of that on the next slide. Melanie says, good to see you, Melanie. I'm so glad you made it. It is great. Thank you for spending Thursdays with us every month. Where do we get off-brand ramen when Big Lots goes bankrupt? That's a great question. I don't know. I'm hoping one of the other discount retail stores will buy the inventory. It'll be strange. It'll be like TJ Maxx's discounted ramen. It'll be like Ramon or something like that. It's going to be something you just find. It'll be 10 for $1. And it'll be great. It'll be terrible for you. The salt will be mind-numbing, but it's worth it. It's worth it because it's all we can afford. Totally worth $8,000 a month in rent. Now, labor force participation increased slightly. Actually, that was basically flat. I'm sorry. This number is a little bit off. Manufacturing retail had a disappointing month, but April, and then I updated this. I thought I updated this. I didn't update it there. But what I'm going to do is I want to talk down a little bit more on some of the other factors too. Education and wholesale trade were basically flat. Transportation's been up and down over the last year. We saw some vast increase in warehousing employment. We had the correction of overcompensating warehouse employment. Now we've seen shipping costs rise again for a bunch of international reasons, and we see transportation hiring go up again. So this is very much a cyclical and international market. The thing that we do need to talk about today is the Fed. The discount rate is indeed lower now. Hooray! What does this mean? What is this? What are we going to do with this? We had Jerome Powell come in. Everybody said, yes, it's time. Is the economy going to improve tomorrow? Is it something where we can celebrate, dance in the streets because suddenly Google's going to hire 50,000 new workers, all at 500 grand a year plus options, and we're going to make this thing happen tomorrow? No, but it is a step in the right direction. The economy is very much like a very big battleship, and we have to, when we do things, when we make any change in course, it takes months and months and months and months to realize those effects. Right now, the Fed is looking at this and saying, the economy is indeed slowing. And they've, through much debate, there are many economists who argue that they should have cut rates a year ago. There are many economists who argue that they could wait and keep rates very high forever because asset prices are kind of expensive. And so the intermediate joint, though, is you look at this and you say, if the Fed is indeed pursuing its dual mandate, why does the Fed exist? Why is it independent? And what is it doing? It's focusing on full employment. It's focusing on keeping inflation around the 2% level. And at 2.5%, we're almost there. I think, though, The miraculous part about this is, so we know that as they, to control inflation, they increase rates, and that increases the cost of investing in stuff. So to build that factory is suddenly going to be more expensive now in terms of the debt that I have to take out. And these collective decisions of making things more expensive lowers the money supply in very tangible ways. It's the strongest tool the Fed has at its disposal. It's not the only tool, but it's the strongest one. And then when the economy, the other side effect, though, of this is the economy starts slowing down, and it slows down in a very substantial way. Inflation is an overheating economy. To get inflation down, you have to turn it off the burner a little bit. You gotta calm down the economy a bit without putting us in a recession. Before this time period, it's been 5 decades of attempting to do that, and we're for very, very little success. And we actually don't have another time. We're trying to thread the needle right now where the Fed is lowering rates to stimulate the economy in a timely enough fashion that does not put us into a recession. The economy is weakening. It will continue to weaken for the next few months. I had a question, is it going to bottom out in October now, and are we good? Oh, no, I think we're going to have a holiday season. I think if the Fed continues to lower rates over the next year, that will line us up for good growth in like 2026. But I don't think that right now we're out of the woods yet, per se. And actually, right now is actually the start of the most dangerous time. Dun, dun, dun. The most dangerous approach to the economy is actually not when we are raising rates, but when the Fed starts cutting them. Because if we go back and say, let's see where the recession started, the recessions were starting after, of course, the Fed had started cutting rates to a level because they saw the economic warning signals there. Albert says 50 basis points was a lot more than we expected. It was. Right before, in the week before they actually made the cut, markets were 74% chance 25 basis point cut. Then immediately in the couple days beforehand, word got out, or I don't know, Jerome Powell's hairstylist said something, and suddenly the market was like, they're going to cut it by 50 basis points. And lo, they did. And given that Japan keeps raising rates and the Bank of England don't seem to know where they want to go, it adds a lot of fascination too. Ooh, another dimension we're talking, Albert. So let's think about this. Pretend for a second, put on your hat and say that maybe you all are multi-million-dollar capitalists that just watch me because I'm like a dancing buffoon on TV, and that's perfectly fine. And you're like, ha, 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 I don't care about this. But all of you, and that's perfectly fine, put on your multi-million-dollar international trader hat for a second and think about where you want to put money. And imagine for a second that boundaries mean nothing. And really, for practical purposes, they don't. You want to put your money worldwide in safe places that generate the most interest for you. And right now, one effect of having the rates higher in the United States than it was in other countries was that money would pour from international sources into the United States to get those solid 5% returns, and it was sunshine and rainbows. Now, as the United States starts lowering rates, international capital is looking around saying, where can we slosh that generates a better return? And so one of the appeals of the Bank of Japan or the Bank of England, depending on what's going to happen to them, Bank of England really needs to stimulate. England's they're beyond. They should be doing this for free. They should be rolling up a chair to the world markets and saying, please help us, please help us. But we've run away with this, and our currency has benefited in sense of being stronger than usual. Now it's likely this will continue to put downward pressure on the dollar as rates decrease because people will move their money elsewhere. That decreases demand for the dollar, makes the dollar a little bit weaker as that comes around. And Albert also says whoever becomes president in January will be inheriting a lot of uncertainty, which they'll be blamed for. Of course, that's the question nowadays. What's the president's going to do? What if president was this and president was this? Presidents do have a huge effect on the markets in general, but in the scope of the broader macroeconomic situation, there's not a lot they can do unless they have congressional support within their party to do stuff. John says, John Gostomsky, dried the excess money up. Yes, indeed. Why does that say the August 2024 jobs report inflation updates? Which part? The August 2024 July, I'm sorry about this, jobs report and inflation updates. August is the most recent month to which we have data. The Eventbrite. Oh, gosh. Because even though it's August jobs report, it's released in September. So we're talking about the most recent jobs report, but it just comes from last month. I'll let Albert interpret the naming of things. Inflation updates. So it is the most recent one. So although it was released in September, the data is for August. So that's a really good question. We're not just going back in time. It's not like catching a rerun of C-SPAN from like August 3rd, and you just have to hit this on replay and pretend that everything I'm going to say is a surprise. No, we're going to talk about it real. This is real time. We got to base it on the most recent data that we have. Labor Department, always my favorite of all departments. So the discount rate dropped. And over time, though, and this is the big point that people who are arguing, and everyone knows one because they're very loud and they're in the office, and you talk to them and they sit by the water cooler and they're like, rates should, when I was in school, rates were rates were 18% for mortgages, and I spent so much money. And that's true. All of that's true. Historically, in time, rates are still relatively low by the US historical standard. If we go back to look at the Fed rate since January 1980, over the last 44 years, rates have come down in general. We had this long period between about 2008 and a little blip beginning in 2016 and then dropped again for 2020, 2021, up to 2021, where we had this 0% rate. That was very common. So it made debt very cheap, and it encouraged asset prices. So things that are based off of debt could be houses, could be other properties, land, things, stuff to go up in value. Real estate, I keep saying different versions of real estate and pretending like they're other things. But asset prices have a large swath of things in the market. Everything from the nature of prices into things, into commodities were affected more heavily by COVID-19. But we've seen over time, rates have come down. Now, a lot of people argue that, hey, we got to keep rates up at the 5.25%, 5.5% level or even higher for a longer period of time. But the hard part is that right now, we're in kind of a difficult situation economically. We've lowered rates. Indeed, we have every incentive in the economy to keep rates low. We're a heavily indebted economy. There's a lot of consumer debt. There's a lot of government debt. When rates go up, that makes it more expensive for the government because they have to pay interest on this. And at the same time, we didn't see asset prices come down. Usually in times where you have really, really expensive mortgages, things like homes sell for a smaller increase, a smaller proportion of their value relative to when rates are small, right? So it should work out in the long run, but rates went up. House prices also went up, and we ended up having the most unaffordable new housing market that we have actually on record. And so that's an incredible issue that the Fed has to take into account, is that the economy doesn't always behave that way. If our economy was somehow different and the asset bubble deflated more and real estate prices came down a bit to be affordable, but we stayed out of a recession, I suspect the Fed would be tempted to keep it higher for longer. But it's just not the reality on the ground that we have right now. And then in the meantime, you've got these shenanigans happening. So the Fed determines this rate. They say the discount rate, and they all get together. Representatives from each of the 12 districts, they get together. For the West Coast, it's all one district because the district boundaries were designed before World War I, and that's where people lived. And then and they made a vote, and they voted unanimously to drop these rates. Now, the other rates in the economy take a signal from the Fed, but they don't follow it exactly. So they tip the hat to the Fed. The big predictor of mortgage rates is the 10-year Treasury. If I plot these both together, the correlation coefficient is like 0.94 over time. So they are very, very close. So when the 10-year Treasury goes up and down, mortgage rates go up and down. Now, the 10-year Treasury dropped because investors believed that the market was going to cut rates in the future. And so much of market rates determine not only on what's physically happening right now, but heavily on future perception, on what rates will do and whether they'll go down quickly or not. So this little increase we've seen on this 10-year bond that we've seen, 10-year Treasury bonds, when the government, by the way, spends more money than it has, which is, as it turns out, every year since the mid-90s, we issue bonds to pay for this. And you own bonds, I own bonds, or my 401k has bonds, my pension has bonds. The Chinese government maintains bonds. Everyone, worldwide, U.S. bonds are traded everywhere. They belong to everyone, yada, yada, yada. But the rates we get on them are variable depending on the demand. And it's ultimately supply and demand for these treasuries that dictate those things. And so there was so much anticipation that rates were going to drop that the rates probably overdropped in the markets in the months leading up to the cut. And so despite this, despite it coming down, the 10-year bond, and this is 2024 here, if you're in the cheap seats and squinting and you've already become legally blind because you've watched this too much, you've been trying to interpret my slides now for the last 53 months in a row, or how long it's been. And then we've gone down this downward spiral. It has bumped up a bit, and the interpretation is traders are just, they oversold, basically. The idea being that they are still trending downward, but in a way that is more aligned to what the Fed's market expectations is now. But we're going to have to watch this because a lot depends on what all the other rates in the market do. So Colin says, if the Treasury rate raises pull money out of the economy by temporarily tying them up in bonds. Interesting. Does it result in long-term inflation as the increased rates just result in more money down the line? Does raising rates just equal more money supply in 30 years? What an interesting argument. What an interesting argument. Let me think about that for a second. So if the Treasury raises rates, and that pulls money out of the economy. So if the Fed raises rates, and what that does is, of course, it's not like we're necessarily printing less money, but we're putting less of it to use. So that multiplier effect of money goes away because we're not seeing those loans taking place. People are demanding less of that. So we know that little story where we turn $10 and we give it to a bank, and the bank then lends it to a bunch of people, including other banks, and they lend it out. And that's that money multiplier effect as it travels through the economy. So higher Treasury rates reduce immediate inflationary pressures by decreasing money supply and slowing economic activity, like straight up. Over time, the government, though, will need to pay higher interest on its debt. If this leads to larger deficits and the need for increased borrowing or monetary expansion, for example, the Federal Reserve purchasing bonds, right? There's potential for inflationary pressure to reemerge down the line. I'm with you. So essentially, the concern is how the government will finance these higher interest payments. And that, of course, the revenue equation is something we're debating right now in the political election. Do we raise rates? Do we raise taxes? Do we not raise taxes? That's a question that somebody asked too. And if economic growth remains strong, I'd probably say the economy can absorb higher rates without triggering long-term inflation, as increased productivity and growth can help manage higher debt costs. But if economic growth does not remain strong and it's stagnant or slow or just a general bummer for years, the increased debt burden then would appear back to us in the form of inflation. So that is a fascinating question, Colin. Go on.
Oh no, I that was like most of my question. I was just like thinking, because people only pull their money out of the market and put it into bonds because they expect better returns, right? But that better return just means, hey,
safer returns than anything, right? So we like bonds.
Yeah, there's just more money here in the long run.
It's more fun because it's safe returns. And even though I'm paying taxes to pay for my bonds, this is a really tricky thing though, right? Because it's also, because we really play this out. Let's play this out for a second, because this is a good question. It's a good intuition. And you're like, well, if I'm the one, if I'm holding all these bonds anyway, and they're giving me higher interest rates, I'm making more money. But the hard part is who owns bonds, and it isn't the average Joe or Jane Schmo down the street who are holding most of their liquid assets in bonds. In fact, the percentage of Americans outside of their 401ks that dabble in financial assets of this type, I realize I become ultra nerd when I get into this, is not high. So as a consequence, then it's like you're shifting the wealth from people who are feeling the effects of inflation on the bottom end of the income ladder to people who, of course, are holding the bonds and generating income from the bonds and living off the income from the higher bonds, who are definitely higher on the wealth ladder. So I would actually argue then it would actually contribute to a general inequality issues that we've seen. Jason says, I was late and just dropped in. Can someone share the original question? Oh yeah, I think it's the one Colin just raised above it. Oh yeah, Colin, can you get to Jason? Yeah, that's right. You can't see it because you just dropped in.
I'll just copy and paste it.
Ask it again. Thanks, Colin. Thanks, Jason, for coming by. It's appreciated. Thank you guys for being here. Oh man, that was an opening volley. What a monologue. So much log, so much monologue. All right, so what we got? So down the line, so what's the job market really doing right now? So if you're feeling a little ill around the job market, it makes sense. Right now, we've been following one of the ways that we track sort of unemployment in general is initial claims. So people who are going on the market for the first time and saying, I'm been laid off, this bad thing has happened to me. And as a consequence, initial claims become an important economic driver, but so does continuing claims. So the people who have not found another job and remain in a situation where they're unemployed. And so if we look at the general trajectory, basically two ways. If we look at initial claims, this is NSA means not seasonally adjusted versus recent non-COVID averages. We can see that the initial claims is trending upward. So if we draw that line in them from December through September, initial unemployment claims are up. Continuing claims versus the average, if we look at this initial time, people are remaining unemployed as well. So initial claims are trending up and continuing claims isn't shooting through the roof, but there is upward pressure on this as well. And so this is really, really interesting. Albert says, no vaccine for this job market. Priyanshi, Fed rates cuts have historically followed by recession. Exactly right. That was the point I was making either. We're not out of the woods yet. This is danger time. 2001 and 2007, when Fed had lowered rates 0.5%, was followed by a recession after a year. Could there be a rise in unemployment and possibility followed by a recession in the next 2 or 3 quarters? Priyanshi, I think that's absolutely possible. This is challenging. So right now, none of these in themselves, the numbers I'm going to show today in any way, are alarm bells, but collectively, they are a weakening economy, and it's certainly a weaker economy than we saw a year ago. And it's likely the economy will continue to be weaker 6 months from now. And this is where it becomes key. The Fed can either push the gas and commit to rate cuts, and they're going to take in a lot of economic information on this. Right now, where the markets are hedging on this, they expect will be about 1.5% lower for our Fed funds rate by next summer, which suggests a series of not so insignificant cuts. This cheaper investment should eventually pile on. But then to Priyanshi, to your point, I mean, if we looking at past being a predictor of future performance, every single recession, not even just 2001, 2007, going back to the tech bubble, before the tech bubble, the 1990 recession, the early 80s recessions, all of those preceded by cuts. And so it's likely we're in the most dangerous phase. And the Fed right now is in a position where if it doesn't, it has to make the right call. This is almost like you have to make an adjustment, right? You've shot a cannonball in the air, and you've got to shoot another cannonball to land on the target without fully realizing where that first cannonball is landing. And they've got a lot of mathematicians and a lot of economists who are making these calculations, but the data itself can be varied, and that can result in a bad situation. I think right now we are below a 50% chance of a recession, but I would not even go much further than like 40% because I think it was really good. Well, I would actually say 2020 in this case. We argued because it was in reaction. You're right. If you're looking at the timing perspective, you have, of course, the COVID pandemic, which of course resulted in a necessity to drive those rates downward. But there was no, that's actually, so we go back to this. We had an inverted yield curve in late 2019, which is bizarre. Because an inverted yield curve, of course, indicates that those short-term rates are higher than long-term rates. And the financial markets didn't know COVID was going to happen, yet COVID happened, and we ended up with a recession that was already baked into the yield curve in the economy. And that's also a fascinating thing. John says, can we get your slides, and how do I get notices for the next meeting? Oh, thanks, John. I appreciate it. If you want to come back, I'm always honored. This is great. I'm going to send my slides to Albert, and he can disseminate them. I will do so. I owe you my slides. Thank you, guys. So in this sense, claims are rising, but keep an eye on this over the next few months. What happens between now and March is really going to be the benchmark for what's going to happen next year. But let's dig a little bit deeper into this weird job market, right? Oh, and I want to make sure I answer a couple of questions too while we're here. I had a question about the Fed. And I had somebody ask, whoops, sorry, all kinds of stuff here. Let me go back a little bit. Let me go back here 1 second here. So I had a couple questions about the Fed. So one person said, I came to Dallas to shut the Fed money pump system down 13 years ago. Never seen a more crony capitalist situation with people protecting and the damaging of the US and the global economy. I brought my degree research, was using the city of Las Vegas as a real-time model for studying the 2007 financial hack on the ground to develop a preliminary model. Now with Fed raising rates for a short time, where it took 12 years to do so. Do you see these excessive funds drying up enough for controlling the proposed situation they took so long to control? So in short, I think that the market right now, the Fed's rate cuts will not be enough to change the trajectory of the market, there's a lot to unpack there. That was a really interesting question. The Federal Reserve's delayed response to raising interest rates has indeed fueled concerns about prolonged inflation, prolonged asset bubbles, and the slow rise has created this, kind of sense of a crony capitalist system where excessive liquidity favored those with easier access to capital, like straight up. But the Fed's moves to raise interest rates, I would argue, actually help curb these excesses. But the effect on controlling inflation and economic imbalances will actually take time. And a lot of that will also depend on, in turn, the government policies that come out after this. And that's going to be a really interesting thing. That's fun too, because we had another question too, and this is a good one too that we'll roll right into. Somebody said to me, they asked, I heard in MBA school that corporate taxes hinder investment in innovation, but Harris has suggested that if elected, she would raise corporate taxes. Who's right? Indeed. So it is true. Debate on corporate taxes is complex, but raising corporate taxes can indeed limit short-term investment as higher taxes reduce after-tax profits that are available for reinvestment. That's the simple thing. You're cutting into the profit margin, there's less profits to reinvest, and that's how that works. But what sort of the big picture for MBA programs is we're not just pulling one lever in the system, there's consequences down the line. So for instance, in MBA programs, we teach lower corporate taxes can spur innovation by giving companies more capital to invest in stuff like R&D. But on the other hand, if you raise corporate taxes, these funds can be redirected towards things like infrastructure, education, and health, investments that may benefit society in the long run at the expense of aggregate growth or corporate growth. And then the whole debate that we have is really a fundamental question of balance. So what is the right corporate tax rate that doesn't put too many resources on one side while preserving whatever our societal goals are on the other? And that's the entire debate in a nutshell of corporate taxes over the last 50 years. And in this sense, and that was a really good one. They were very thoughtful questions. You guys always ask such really good questions about this. Moving down here a little bit and going down a little bit. Oh, Albert asked, do you see any situation where, say, if the market turns really bad, that you'd see Powell engineer a Fed put to zero, like on the eve of the pandemic? Oh, yeah. I think absolutely. If the economy turned bad, and it would have to be really an unanticipated external market shock. Something had to happen where we thought the risk level was this, but it was actually much, much higher. And like either that we had in the pandemic or before that, the banking crisis and other things. And that isn't readily apparent. I'm searching the market right now for where that would occur and how that would occur. There's a lot of doldrums in the economy. I mean, it's not sunshine and rainbows. Nobody's out there riding, Pegasus to work every day and saying things have never been better. A lot of people are actually. I'm sorry if you ride the BART has its own Pegasus system. But if you're riding that to work every day, I appreciate that. But if there is an unanticipated global shock, could be war-based, could be other issues, that sends economic trade spiraling in one direction. Absolutely, the Fed will just knock that thing down to zero like there's no tomorrow. And you're right. Bloated car notes, credit card default rates have reached a high. For instance, that's a good point. If we look at new default rates on automotive loans, and this is from data from the New York Fed from third quarter, I think we hit 8% on the new loans that are greater than 30 days delinquent, which is the highest we've seen since really about 2010, 2011. And so we are seeing credit markets under strain, people under strain in this situation. So that's absolutely true. Absolutely true. Now, let's dive into this a little bit more, because a lot of people are saying, well, Riley, they didn't say this. You're so kind to me. You're always so nice to me. But I always think, I'm like, what? I'm only playing devil's advocate. What are the diabolical thoughts that the Albert's List audience will be thinking? Well, you're looking at this and probably saying to yourself, the economy feels weaker than it seems. I hear you, Riley, when you say full-time prime age employment is pretty good and near highs, but it doesn't feel that way. So in the black and on the left-hand column, we've got this like 80% of people in prime working age are employed. That's about as good as it gets. But the full-time prime age employment, and this goes back to Albert's point about part-time employment, is decreasing. And even though we've maintained good numbers up here in people who have a job, the people who have full-time jobs is dropping. Some of that by choice, perhaps, but a lot of that is not by choice. That's by firms cutting hours and an availability of jobs in certain positions. John says, YouTube on what is an auto auction yard with the banks not selling as they finance too much in price for these vehicles, all types. You're right. So we've seen this, John. This is interesting. So in the COVID pandemic, we saw a rapid increase in the price of used cars. Inventories were low, demand was high, prices went up. And indeed, if we go to the used car market, and I just did a local news show about this, so the data is fresh in my head. Used car prices went up 40% in price before the pandemic to in the pandemic. Since then, to your point, inventories have been increasing, but remain even below pre-pandemic levels. But demand for cars has slowed significantly, and therefore car prices have dropped about 20%. Now, we're still over 20% above where we were back in pre-pandemic times, but the prices continue to drop, and it continues to be more favorable for the used car market. In the new car market, we've seen the prices are kind of leveling off. They're decreasing a little bit now, but they're still high. And to your point, it's going to be a lot more competitive now. So if you're in a position, and none of us really always have a choice, if you're in the unfortunate position where like 2.5 years ago, during the peak of used car bubbles, and your car is riding on the freeway and it breaks down and you don't have a choice but to buy a new one, you are majorly bummed out because that was the situation back then and you had to overpay for any car anywhere. Now that's becoming a little bit better, and I suspect it will continue to be so because of weakening consumer demand in the overall market. But we're seeing also more part-time workers. And then this is the surge in part-time work among the prime age cohort. This is highly unusual. This is what's really weird about this job market. Part-time prime age employment. So prime age is, again, that working age. You're between 25 and you're from your 20s until your 50s. So this is the area at which, we're productive. We're making careers of ourselves. We're leaving regular markets to become professors of finance in strange parts of the world. Your part-time prime age employment population ratio is increasing, although not by much. That right-hand side is not a huge increase, but it's unusual for this market to see full-time remain high, but part-time increase. So all the additional surplus labor is going into part-time work, it seems, which is fascinating. And Albert points out this is the biggest concern. What mechanisms can we put in the labor market to incentivize transition from part-time to full-time? Part-time to full-time? That's a great question. And so part of this depends on, let me give you an example. So this is tricky. What are the effects of increasing minimum wage? So let's think about this as an example, right? So let's put both your worker hat on and your business owner hat on. So your worker hat is, thank goodness I can finally make more money in this place. And what do businesses do in responses to increasing the minimum wage? They reduce the number of hours they give to their employees. This is not always the best metric. So if you were being a full economist about this and not a caring human being, you'd just be like, well, we need to make labor infinitely cheap so I can just make people work for $2 an hour for 80 hours a week, and then we've got more than full-time employment. So that's not desirable for a bunch of different reasons why that would be the case. But to the point is that there's always a give take between the policies we institute and then what businesses do with them. Because businesses are clever. You say, oh, you raise minimum wage, I just cut hours and we make do with less. Do you have geographic data on where part-time jobs are increasing the most? That's a great question. Part-time jobs increases. Not right now, but I like that for next time, at least, Albert. Man, let's see if I can find that data. I got some data in aggregate, but then I'm going to have to scale them by, oh yeah, job growth. Part-time job growth, though. Part-time. Come on. I have to look at this. Then I have to vet the sources to make sure I'm not barking up the right tree here, wrong tree. I'll take a look at this. I don't have the geographical data, but I like it. It feels that way. And especially from a transition side point, where is it happening is a big question. I'll see if I can dig it up. Let me mark that on the list. Late October, I'm coming back. Consumption junction. Rising credit card delinquency rates. Yes, I remember I put this in here somewhere. So this is fun. This is from the Federal Reserve Board, U.S. Federal Reserve Bank, Goldman Sachs, of course. Got to give them a shout out to GS. So if we look at the credit card delinquency rates, right now, and we look at these percentage, and we've got a whole bunch of different numbers here. That little gray line is from the New York Federal Credit Panel. These are credit card loans that are more than 90 days delinquent. So if they're more than 90 days delinquent, those loans ain't coming back to you. That's what we say. We write those things off. It's like, oh, light it on fire, throw it in the woods. No, wait, no, bring it back. Don't cause no wildfire. In the red line, that's the new delinquent credit card balances. So that's the percent of current balance delinquent. And then in the blue line, you have the new seriously delinquent credit cards. And then finally in the light blue line, all insured commercial banks, all credit cards from all insured commercial banks and that general loan delinquency rate. So depending on how you quantify your delinquency, you can find that credit card delinquency rates are indeed up. The average credit card debt for an American is a bit more than $6,000, which is a lot, controlled by relatively few Americans who can maintain such a high revolving balance. But it is crippling because it's often, of course, the most expensive form of consumer debt. Also, let me grab that number here. So we're seeing these trend upward. They are not at catastrophic levels, but they've now exceeded the levels that we saw in the last growth period between the Great Recession and the COVID pandemic. And they're likely to continue to go up. And where it reaches catastrophic concerns is if it was on this trajectory in like another year or two, we'd be at a level where, hey, this looks pretty bad. We're in for a bit of a crisis. So that's one of the reasons I look to this and say, when people are like, we're not going to have a recession, I think it is still very possible that we will. And that happens because people are more nervous about this. The consumer environment as a whole becomes more wary of spending money. And then as a consequence, that has this feedback loop where jobs get laid off, people then spend even less money, and then the Fed's in a situation where they have to really bring out the big bucks to stimulate the economy. And then here on this side, we also have the 60-day loan delinquency rates for auto loans also rising. Subprime auto loans are not a big portion of the auto loan market right now, but those are high default risk rates, not like they were in the pre-2008 financial crisis days. But even our prime auto loans, these are our good ones, the good ones at good interest rates, their default rates are up back to the highest level that we've seen since the Great Recession as well. Shenanigans. The last time it was cheap houses, what will we be able to buy on sale this time? Consumer goods, unfortunately, not the assets that we're looking for. And that's the downside. Save functions, savings rates, another sign of consumer weakening. Personal savings rate is 2.9% in the country. My goodness, if you look to any other country, we have such a low savings rate. People are like, what do you do with your paycheck? I'm going to spend it. You have to. And some of the things, it's not like people are always buying the vacation in Tahiti just to keep up with, there's not just keeping up with the Joneses, it's just maintaining consumer expenditures under duress. And those savings rates have come down to such a level that now, if we look at the US economy and how we're relying on, a lot of our surplus savings that's generating the economy are foreigners' net savings in the US. But as we lower these rates, it's going to continue to put pressure on people who are from other countries, taking that money out where they can, putting it in banks in other currencies that make a bit more sense. So what's your take on this? U.S. Treasury bonds, says Melanie. Yeah, that's great. It's the ultimate gift, a 30-year municipal bond for your a $500 cash value selling for like $150. It's a great, clever gift for like a niece or nephew. And they don't figure out that you're stiffing them of more money until they're like 16 and want to cash it out for a car. Oh. But anyway, that's that. Hold on, got to get back to that real quick. Really bad at multitasking. Now, fundamentals on the economy. Commercial real estate, says Colin. Oh, yes. We're going to be a lot of that. It's hard to convert that, and Colin's actually right. I can't avoid CRE. We're going to talk a little bit about that down here, but we're going to go back into the residential markets a bit deeper. John says, my degree was in using the city of Las Vegas to study the financial hack of '07. The economy is pure capitalist, amusement park economy, a July economy. It is amazing. Las Vegas, I know. I'm there more often than I would like to be, about once a year for one reason or conference or another. It is indeed not my favorite city, but it is a city with a unique economy and growing one at that. That's what I can say. There's going to be like, I'll get like an email from like Big Las Vegas. I don't offend anybody. I like Las Vegas. It's fine. Vegas is good for about 4 days and you're ready to leave by day 2.5. That's absolutely true. Real-time model window. I love that you worked on that, John. That's fantastic. And I appreciate it. That's good effort on this. I was modeling my bank's default risk rate prior to the mortgage crisis, and obviously that didn't work out for me. But it's always worth doing it. Wealth care. Fundamentals still look okay. Now here's the thing. All right. So in this chart, red is bad, green is good. However, what's doing well, what's doing badly compared to past history? Right now, our wealth conditions in the economy, and wealth is concentrated among people who are in the higher decile of income and have higher resources. They've seen asset prices increase. They're the homeowners. They've also seen stock market prices increase. People are richer now than they've ever been in aggregate. However, that is not evenly distributed. Debt. We're actually right now, because our mortgage debt, that big chunk of our biggest chunk of consumer debt, although is a mortgage, although these rates have come up, most people still who own a home possess a mortgage that is somehow booked at pre-2020 levels. And as a consequence, their physical financial burden from that mortgage is less. So overall, our debt burden is still pretty good in the economy, which is why that even though credit and automotive loans are high, the debt portion, the mortgage portion of this market, we haven't seen that increase, and that's why it's still green. Consumer confidence is not so good. Income growth has not been good. Spending growth has been relatively mediocre, but employment has remained high. What's gonna trend is gonna be this. Employment's gonna be on a downward trajectory, and when that happens, consumer confidence will also drop. That will put pressure on wealth, but we'll see what happens right now. We don't have a lot of mechanisms to drop the market tomorrow, but it will be something we have to watch. Debt too, and all of this can change in a fairly short amount of time, but we usually get a warning, as you can see over time. The shift is typically gradual. Albert says, I met a couple last night that sold their home in LA at a 2.5% mortgage rate and traded it for a Paso Robles mortgage for 6%. It was definitely painful, and these people exist. I have a 2.5% mortgage. I am so fortunate, Albert. I never thought in my life I shouldn't even be here. I'm the son of a waitress at a Bennigan's. And here I am, and I'm so honored to be here. But I keep thinking to myself, it is amazing I possess a mortgage at this rate. But to the downside of that market, I absolutely do not want to put my house up for sale anytime soon, because that mortgage rate is just too sweet to give up. And so as much as I can complain about X or Y and dream about, trading my house in Santa Fe for a Mediterranean villa next to Albert in Paso Robles, it's going to be a thing. Albert says, do you think an economic calamity would be this year's October surprise for the US election? Ooh. Let's think about this. That would be a huge surprise, and it would be a very interesting thing. Right now, the sense of the economy is that it's not doing well, and this is adversely affecting the incumbent President Biden, and by default, Kamala Harris. And we're in a situation right now where the economy could very well, I guess we could have an action. We could have a negative stock market result even. That could be just some trading mechanism that happens because of, some number was triggered and X happened and Y happened. Even though I don't see it, and precisely because I don't see it, I also suspect that there's a non-zero likelihood of that happening. So that could tip the economy, tip the election, particularly since it is expected to be this close. And it always would be a negative thing for the incumbent party. And so that'll be a very interesting thing to see how that pans out. John says, the thesis for my bachelor's degree, take a steady economic system, inject all the money, lawyers, bogus financial data, you create momentum, overwhelm the system, and then introduce fraud. That sounds like also a fantastic novel. Albert says, Serena over on YouTube highlights that 7,000 person layoff at Cisco that occurred recently. Yes. And Amazon also doing soft layoff with forced RTO. Absolutely true. We've seen that too across the board. So I have another couple questions about the So let's talk about this too. Speaking of hiring. So let's think about Silicon Valley. So somebody asked me as well. Oops, sorry, hitting the wrong buttons here. There we go. We'll go back a little bit. And I'm going up to put all my questions in a Word document, and I scribbled notes on them so I could figure out a way to ask. I could remember to go over them with you all. So now in short time, do you see these? What will it take for hiring to get back to normal in Silicon Valley is the question. Meaning not just getting unemployment down to a reasonable number, but also getting these big companies to start hiring enough full-time employees again instead of short-term contractors. We used to get tons of recruiters contacting me all the time for contracts for 1 or 2 years, but now I'm lucky to get 2 recruiters a week contacting me about contracts for 6 months or less. Bum. So getting on that, hiring in Silicon Valley. Okay. So my thoughts are this. Silicon Valley's shift towards short-term contractors is tied to a much broader market uncertainty based around cost-cutting measures. When tech firms who rely heavily on external investment in startup capital to get off the ground, right? They have a very different approach to getting the capital, although money's sloshing around in VCs and private equity, and there's all this other opportunities. They're also really hungry for returns and generating those returns. That puts a lot of pressure on these startups in particular, who have whose value depends on the promise of the future to generate clear avenues to profitability in a shorter amount of time. Remember, if you're an investor and using a survey of around 200 companies, I teach an entrepreneurial finance class. And there's a tendency, if we look to just a data set of companies from about 10 years ago, we found that between the time an investor gives money to a company and a time where they can actually earn enough money to get paid back, meaning their net zero on their investment, it's at least 6 years on average. It's 6.5 years. But with the introduction of a lot of market dynamics right now, private equity in general, other things, there's been a big thumb on making that sooner, making that more profitable, and making that happen. And so you're seeing tech companies used to be able to mass hire to get away with all this potential investment being much, much trickier. And I think this is a combination of that cost-cutting measures, high interest rates, inflation, global supply chain disruptions from 2 years ago, over hiring and then firing. And to see a return to normalcy in full-time hiring, you need a combination of stable economic conditions, lower inflation, aka also lower interest rates, and restored investor confidence in this market. And we're just not seeing all of those things. It is possible that in the short term, we could see, for instance, like a leaner workforce with a reliance on contractors, but still companies maintaining profitability. But once companies regain confidence and sustain growth, and particularly globally, because global markets are a little bit in shambles, full-time hiring could pick up again. But that is a tricky situation. Unker says, Dell is doing the same. Forced RTO. Wow. Albert says, do you have any thoughts on Alan Lichtman's presidential predictions? Yes, that's right. I know him. Not personally, but wait, I watched him talk about his predictions. He's the guy who's gotten every election right since '84 except 2000. One of his keys to victory is strong short-term economy, which means the US is not in a recession during the election campaign. So my thoughts about Alan Lichtman is, and I'm an academic myself, and I understand how one makes presidential predictions that are model-based, and I understand building models to generate outcomes. So my take on this is, he's going to say he's right regardless of how the election pans out, because you can argue that the economy is actually doing well despite consumer confidence saying that it's not, in which case then you'd say, oh, in that case, the incumbent party, Kamala Harris will win. And then on the other side of it, he can say, well, since perception is that it's bad, despite economic suggestions in general that it's not so bad, but the perception is that it's bad, that's why Trump won in 2024. And he's going to spin it both ways. And so that's my belief. But I'm not against Alan Lichtman's anything as well. I think that it's a very interesting phenomenon. We have models out there that predict all number of things. We have 50 years of historical data where we've raised interest rates and then started cutting them and then ended up in a recession each time. But that doesn't necessarily equate to this time being the same or different. Things are weird, and we're only as good as the data that we put in. Oh man, another question. So we're seeing, somebody asked me, Dr. White would like to know what the specs tell us about manufacturing in the US, AI sustainability issues, and employment markets for women over 50 with tech skills. Yeah, rock on. Thank you. Let's talk about that. So, US manufacturing sector, we're seeing a push for reshoring. Greater domestic production. We have geopolitical tensions and just a gamut of supply chain vulnerabilities. AI and automation is going to play a significant factor in reshaping this. We've seen investment this way. People are saying it's oversold. It's already increasing productivity in weird ways that people are keen to admit to, from that email you edited just a little bit in ChatGPT to other things that may happen. People are developing familiarity with AI in a better way. But this is a generational change. It doesn't happen overnight, and AI is not coming for your job tomorrow. But what happens is then when the next recession happens, or when tech layoffs workers, they just don't rehire them back in the same places anymore. So I'm not a Malthusian when it comes to AI right now. Now, for women over 50 with tech skills, opportunities I think are growing, especially in areas like project management. We see this over and over and over. Data analysis and AI integration. I think employers recognize the value of experience and adaptability in tech in particular, but overcoming age bias remains a challenge. It is a thing in this market as it is for the rest, but don't let that deter you. The key is to stay adaptable and continue upskilling, align with emerging technology trends, and show that you're not somebody who's trying to relive, the workforce 10 years ago, but you're somebody who not only possesses the wisdom of somebody who's been in the job market long enough to understand the right decision making and the consequences of that decision making. That is what you have to sell to people. And I guarantee you, I'm on like countless hiring committees, and that is so much more impressive than somebody coming in and I just graduated from so-and-so university and I've never done anything but 4.2 GPA, bam, do it. Defeat the people who are naysayers and win. We got another question too. Yes, thank you, Albert. From Melanie, in the debate with Harris-Trump, promised to enact tariffs. Have any presidential tariffs affected the U.S. economy positively? Oh, I like that contrary one. Well, Riley, is there a positive tariff example? So tariffs, yes. So I'm sorry if this is your first rodeo with me, your first like economics to do. Thank you for sticking along with this. I went over, I think 2 months ago now, or maybe we did a, back and forth of two policies that both presidential candidates were talking about, and how economists in general were not crazy about them because they involve tariffs to different extents. And so one is that former President Trump's candidacy relies on sort of a mass tariff across the economy, and there's two consequences to that. I'll explain why that's bad, then I'll actually answer your question about has it been good. So in this case, one thing to think about tariffs is they make things more expensive. And a good example of this, and this has been done case study and case study and case study over and over again. If you raise tariffs in one industry, you're making it more expensive for all the other industries that depend on that industry's product. So if I say, I want to preserve US steel, I increase tariffs. Well, we don't have the means to just build we're not going to start producing steel at a lower rate. We're just making foreign steel more expensive, which means that when we compare prices across the board, hey, if we raise foreign steel prices 10%, maybe US steel is then competitive. Okay, so now we have to pay this higher rate for US steel. US steel may be a superior product, it may be a worse product. But then that input cost travels directly into everything that needs steel. And so you can save a bunch of steel workers' jobs, but you're going to unemploy a whole bunch of auto workers' jobs and construction worker jobs and a whole bunch of other jobs that rely on steel as an input product. And so that's why tariffs don't work the way people think they do. It's not like you can just shut off one lever of the economy and pretend that it doesn't affect 2 or 3 things down the line. And that's the naivety of tariffs. And I think that's the really hard part about it to grasp. And if we talk about this as an example, so, okay, maybe, all right, let me summon something from the abyss. Let me look this up briefly. Reagan had some tariffs on motorcycles. The 1983 motorcycle tariff. So this is good. Okay, here's what we got. So the tariff was there. I'm dropping it in the Wikipedia. It's right there, the motorcycle tariff. Motorcycles were, okay, the tariff was set at 45%. It dropped to 35% in the second year. And this did improve motorcycles and kept out German and Japanese motorcycles from taking over the market, allowing, Harley Davidson to succeed for a few more years. And because there wasn't like a huge number of other industrial purposes for motorcycles, like they're not an input to other things, it didn't have the negative costs that involve other things. The other thing that you have to worry about with tariffs, by the way, is not even the fact that it makes stuff more expensive and puts pressure on inflation. Tariffs also create a situation where if you're setting tariffs for the economy, you're gatekeeping in certain sectors. And then I think the original policy, and correct me if I'm incorrect, that President Trump or former President Trump has proposed is that there would be some exceptions to certain rules that would go through an approval process. So you're shifting the power away from market forces into a government approval process where you're basically just allowing the president, through approval and unapproval of tariffs for different industries, to award for cronyism in an economic sense, to manage tariffs and exceptions to those tariffs at the government level, which don't necessarily serve the interests of the American people. Ba-dum-bum-bum. That's what I got. Albert. So, okay. Thank you for watching this. Aaron Reyes is watching on YouTube. It says China, Japan on YouTube, Aaron. Thank you for coming apart. I missed you in the action. I thought Aaron sent me a whole bunch of great links to a lot of things. And I want to talk about all of them now, but I just didn't have time. But we'll get to them. Keep sending them, Aaron. I appreciate you. He says China, Japan, and the EU have used tariffs to manipulate their prices in competitors. That's true. So you can say this and say, well, but here's the thing. For the United States, it could be like, well, they do it. It depends. I don't know what angle you're taking that. If it's like, other countries do it, so we should, or other countries do it, and that's why we shouldn't. From an economics perspective, purely bad idea. Tariffs are taxes on goods. Indeed. And as a consequence, we unfortunately, 2/3 of our economy are consumer based. So we're an economy based on buying stuff. And as a consequence, when we mess with that lever a little bit, then we get negative economic consequences. But I agree with Aaron. I mean, Aaron knows the case better than anybody. He's awesome. So housing. Let's talk a little bit about these shenanigans. Thank you for those of you who are still sticking around. I know we're already at 6 o'clock Pacific. National rents right now, despite the fact that due to a large increase in supply, we've been able to drop rent increases down to at least appropriate levels, but notice that they're not coming down and remain elevated to where they were previously. Now, home shifts across the markets have been highly uneven. And looking at the 50 largest metro areas, shout out to San Jose, California, for the biggest year-on-year increase in real estate prices, 9.1%. Congratulations, slow clap. Please build more things. That's interesting. Melanie says, my dad bought a Honda motorcycle in 1983, tariff or not. That's funny, Melanie. Tariff be damned, said Father Archer. And then he put out his cigar on his Honda motorcycle. I don't know. That's a hypothetical. I have a Melanie backstory. But one of those things is really interesting. That's fascinating to note, that despite raising prices for international motorcycles, people still do what they want to do anyway, which I think is a really interesting point. Yeah, I like it even more now. That's right. He's one of those guys that's like, hey, he shops at, hey, they just raised the price on eggs, $3 an egg now, and that means they're even more valuable. I got to buy more of them. I got to invest in eggs. I love it. It's not always fun. Honda motorcycles are reliable, and he had an eye towards, deals. So another shout out here, and I love this. Max Dubler had this on Twitter recently. Worthy follow in this sense because he talked about real estate. I'm picking on San Francisco, the city itself this time. I got to pick on San Jose last slide. You know the deal. You're not building anything in areas of the city where you could build things. And, for shenanigans and giggles, I looked up. So my grandmother, entirely born and raised San Francisco, lived her whole life. Her dad opened, she was born in 1919. Her dad opened the first auto mechanic shop in, he says California, but at least San Francisco. And it was an auto mechanic store. He had California license number 24. He'd chauffeur people around in a car that has no name. I got him by that picture of him next to the Cliff House back in the other Cliff House, the second one. And they lived in a very relatively inexpensive home in outer Richmond. So over here, right? And I was looking, I looked in the 1940 census. I'm like, how much is this property worth? 1940 census will tell you that home was $5,000 in value. And you're like, but it was a typical, neighborhood, regular working class neighborhood, $5,000. If we took that and matched it with inflation today, the equivalent price for inflation for that $5,000 home in outer Richmond would be $112,000 today. Nice. 112 grand for a house in San Francisco. Isn't that lovely? As it turns out, this Very, very small home, of course. Zillow estimates it at 1.5 million right now. Why don't we just stay in one place so we can get some inherited wealth is my question. But you need to build a lot more to get there. And we're finding a lot of times, and we look at real estate supply as being key to this. There's a bunch of things that I think have happened recently that have shaped people's opinions about real estate. And whether you feel on this or not, supply has to factor into our solution process for this. And the reason I bring this up is that real estate in general in the United States since the early 1940s, this is every increase we've had in real estate prices since 1942. Very infrequently do we see real estate prices actually dropping. And indeed, if we go across the board, it happened in only 7 years. 5 of those years were in our lifetime, immediately preceding and causing the financial crisis of '08, because we had an over vigorous real estate market. Since that time period, it just there's just an expectation in general that real estate prices will rise, even if the long-term average is 4%. There's not a mechanism by which they will drop. And Colin says, "Can I stop living in unprecedented times?" And so the hard part about this is, and I think we can. My thesis on this is we can stop this. The only way we can see this meaningfully drop is if our supply somehow increases. And that's density. That's building a lot in places that don't have a lot of building happening. Housing affordability. If I shoot up this slot here, we go right across the board. Oh, sorry about that. I got to prioritize my windows here. Right now, this is everything on the top right. This is the sad corner of this chart. High down payments, high monthly payments. At the bottom, bottom left, this is good. Low down payments, low monthly payments. So we are right now as unaffordable gets regarding our unaffordability. How great. And then, of course, Brian Albrecht, who's a very amusing economics guy on you can follow on Twitter as well. The solution that everyone thinks of is this a sign? And no shame on Kamala Harris per se, and she's got a lot of good economic policies and some iffy ones. But her response, and this was a response to her proposal, which is basically like, hey, we got to make it easier for people to afford down payments, which is true. But that is a form of demand subsidy, and demand subsidy doesn't actually solve the problem. It actually exacerbates the problem, and that's what this cartoon eventually says. Is that we really, really have to look at supply here as well. And I've seen some counter arguments on this as well, but I don't find them based coherently in what the data is actually looking at. So build, build. The best laid schemes of price and oil prices. Let's talk about that. A shining light. Oil prices have started to drop a little bit. Yay. Can they go up or down? I can't predict it, neither can you, and don't pretend that you can. It'll go up and down, it'll change and variable, but it's right now on the downward end. And that's important for you to know. By the way, West Texas Intermediate is the price of the futures price per barrel of oil, and that's determined magnificently in Cushing, Oklahoma. The next time you're in for a central part of the U.S. field trip. So wind capacity on the other side has grown a lot, but not nearly enough to where we have the capacity to build. And that's for states like California and New Mexico, but we still trail states like Texas in installed wind capacity. Texas has essentially 6 times more installed wind capacity than California, although, it's only, let's see, it's 250,000 square miles. California's like 150,000 square miles. So it's only like, 60% bigger. And so you've got that. And then you've got you've got a lot of potential to continue building power grid and building stuff. Other things, inflation's under control. Yay, inflation situation coming off the high. But our interest rate's going to come down. We expect it will continue to go down, and markets are projecting the Fed will drop another 1.5%. Another thing I wanted to bring up, construction. Even though construction manufacturing jobs are down, construction is up, and we're seeing it in manufacturing structures because of the CHIPS Act, and we're still seeing that growth pervade the market. Now, those of you who always ask about investments, they say, what happens now? What should I invest in, and what's the money look like? Small caps have typically outperformed large cap stocks, so smaller companies outperforming large caps in the 6 months after the first rate cut. But they've underperformed in the initial months, and they had mixed performance over the last 12 months. So another interesting thing to note. Aaron is back. Oh my gosh. Aaron, he couldn't stand it anymore. He's like, I get it on my computer. Riley's gone rogue. I gotta reel this guy back in for a little bit. Thanks, Aaron. I appreciate. It's good seeing you. It's good. I appreciate Aaron is my number one source for emailed economic links. San Francisco, Oakland, Hayward, California, San Jose. What's the job situation looking like locally in the Bay Area? As you can expect, unemployment jumped from June to July. We don't have August numbers out yet. Those are always delayed even before, but even more delayed than national levels. But we're looking at an unemployment rate that jumped to 4.6% in San Francisco, Oakland, Hayward, San Jose, Sunnyvale, 4.5%. And we're seeing continued effects of that stressed out information sector. We're looking at financial activities in both areas down. We're looking at information hiring, 6% less than it was 12 months ago in San Jose. In San Francisco, that number is 8% less. We've got 4% fewer manufacturing jobs. We have some good other services are increasing. We've seen increases in education and health services. But you know the industries, and they're not doing stellar right now. Going back to my list of questions to finish us up today, we've got a few things to note. Let's see here. I want to make sure I missed this. So I answered that we feel like we're at rock bottom. What to expect from growth, new job opportunities in the San Francisco. What? Okay. When to expect growth, new job opportunities in the San Francisco Bay Area as a result of the interest rate change. Got to wait for this thing to hit the system. If the Fed continues pushing the gas on this thing, we're going to see some benefits here. The Bay Area job market is really heavily influenced by tech sector trends and interest rate changes. When interest rates stabilize on a downward trend, we're going to see more venture capital flowing into this market in both new and established companies, and that'll help spur job growth. However, this is going to be gradual and it's not going to happen overnight. Maybe improvement by midpoint next year, but I suspect it will be over the next few years in general. But stick with it. And that's the hard part about being the canary in the coal mine is you're the canary and the rest of the country is the coal mine. So you're going to feel that effect first. But when the canary dies, we'll buy one. We'll buy another one. We'll buy you another canary. You guys, we'll be fine. We're going to have another canary. We'll buy 12 canaries. No, I don't care. You don't have that level of canary density built into the Bay Area. We'll spread them out over large 1 acre lots. Canary contractors, Melanie. Aaron says housing fundamentals, percent of our wealth and sector size versus corporate and government, percent of GDP has increased 3 times since 1980s. You know, Aaron's right. He's right, guys. Aaron's right. He's not kidding. If you can, you have to aggressively make housing cheaper. That's better permitting, that's greater density. Throw it out the window. Nobody wants to do that, and instead people will clutch onto their homes. And that's the hard part. I don't even see a political will that can make that happen, given even that at the aggregate California level, there's been a lot of stuff that's been shaken. But as we know about environmental laws, environmental protection, and very good things that have very good intentions can often have bad developmental effects that negatively affect livability in these areas. So that's the hard part. Man, Colin.
Hey. So I'm just looking at the data series IT, maybe just because I'm in it and a lot of people in our group are probably IT adjacent or IT focused. IT is clearly negative 8.1%. Is that historically expected? Do we have any historical context?
Is it precedented, in other words, right?
Yeah, is this precedented, unprecedented?
So it's better than 2001. Yay. Yeah, 2001 tech bubble. Yay. But it's better than that time. However, it's not good, and we haven't seen this year-on-year decrease in a little bit of time. I'll actually bring up and I'll show you the what's more interesting to you. Do you want to do San Francisco or San Jose? What's your pick, Colin?
San Francisco. Let's go San Francisco because everyone probably. But
the Bay Area is too powerful. They do have to divide you. They have to divide the Bay Area. It can't just be one metropolitan area.
2001 was accompanied by a stock market crash, though, right?
It was. But to that point, and what you've seen, if we take this, at least in the recent time period, why it's kind of unprecedented. Sorry about this. Let's move this around. Sorry, I didn't mean to tether those two graphs together. So we've got this thing going on. This is the employment in the information sector in the Bay Area since 2014. So look, Up, 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 higher, higher, higher. Oh no, pandemic, layoff, layoff, layoff. It has been like this. This period of time, to your point, Colin, because it's been a multi-year doldrum, is we got to go back basically to the tech bubble to make that happen.
Okay, so we've basically undone 4 years worth of
Right. Does it feel like exactly? Does it feel like 4 years ago? It does, because it is. It's the same amount of employment 4 years ago. That, and it's just continuing.
At what point of this continuous downhill should we sound the alarm?
Well, I mean, it's because the direction has changed. It's interesting. I think so. Here's the real slide part about this, right? Right now, as it stands, no lie, you are still the ground zero for entrepreneurial capital in the country. That's still the Bay Area. When it comes to starting a business and making that money happen and cashing out and resources and infrastructure and people who know how to do it, it's still Bay Area. A chunk of those people have moved away. A chunk more of these people are going to continue to move away to other areas. And it's a trade-off for these companies because companies are saying, I can't attract a labor force and still operate in this space. So I got to move to Texas or I got to move to somewhere else. And the downside is there's a great will to move to live in California in the Bay Area. And my guess is if I looked at people who were not necessarily Bay Area natives in this audience, may have come from all areas of the world to be here. There is a reason, a compelling reason, and maybe cultural, maybe a desire, maybe a demand to come to the Bay Area. And then maybe some of you guys have just been here for generations, and it's like, yeah, it's fine. I inherited a house, and that's cool, and that's also perfectly fine. And you come to this position, and wherever you come from, there's a demand and a will that you can make this thing turn around. But you really gotta. The other calculus is it's so unaffordable to live. It's so hard to keep people. As long as you can still attract top talent, absolutely, tech firms can do as they please. But as soon as people say, gradually over a generation, I'm going to pick up and go to Texas, or I'm going to go to Nashville, or I'm going to go to New York even, or somewhere else. Instead of the Bay Area, that's a lost personality, a lost innovator, a mover and shaker. So it's got to turn around, but you got to make the calculus better for both firms and people who live here in the Bay Area.
Maybe I'm like behind on the stock market news, but as far as like remember, the tech sector is posting record profits while firing.
Despite firing everybody, because they're
Yeah.
streamlining their business. Exactly right. Largest firms in the country are tech firms.
So is that precedented or unprecedented?
By market capitalization. So right off the bat here, I'm just going to let me just drop this too in the window. So tech companies have been dominant over the last, really the last 20 years have been a good run for them, but really in terms of capital market cap over the last 20 years, I'll just show you, take a look at this. So these are the largest American companies by market capitalization right now. Here we are. Right here, come and get them. The market cap of $3.5 trillion, Apple, Microsoft at 3.2, Nvidia, it's Google, it's Amazon, it's Meta. Look at all that money.
Nvidia is kind of new here, though. Let's be honest.
Now, Nvidia doesn't know. They are the new person on the block. That's right. Let's not
Yeah.
give them a noogie. We don't invite them to the neighborhood parties. I understand, Colin. You're more of a circle the wagons here. But yeah, I understand. And then you got Berkshire Hathaway, which is also up there, and Broadcom.
Broadcom's definitely tech.
Definitely tech.
So
Berkshire Hathaway has Dairy Queen. That's that's technical enough.
they're doing well on the stock market, but they're firing. Where does this end?
So as long as they can get away with it, they can. The company is on an effort to be. So this is really interesting. So a really broader question is the Magnificent Seven, let's say, mainly tech stocks that have dominated the market in the last few years. The unprecedented concentration of high stock market growth in very few companies. Usually this ends badly and it always doesn't last forever. And so something happens. And so either at some point people will take their money and invest in better returns. They will produce. This is interesting. I don't know how this will pan out, but this is a ripe area for revolution as far as it comes across, because another dimension, and is stock market concentration. And Aaron's just dropping some really good ideas in this window, by the way. So keep an eye on that, guys. Stock market concentration. I just want to grab a chart that I saw. Morgan had one, but it was kind of outdated, but I just want to. All right, here we go. Well, this will do. This will do. So right now, if we look at the value of the US market, it is never been this concentrated since we got to go all the way back to like the 1960s, where we saw the top 10 largest companies have more than a quarter. This is even a year outdated. It's actually still continued on this trajectory. About almost 30% of the value of the stock market is in the top 10 companies. Top 3 companies have 15% of the value. And top 1 company has 6% of the value of the stock market. Which makes sense. That's about right. Apple is about 6% of 58 trillion, which is the aggregate market cap.
Make antitrust lawsuits.
Interesting. Break it up.
Make him vogue again.
I know. It's true. That's going to be a battle too. So it doesn't really sense. Capitalism works. Capitalism works. It's a good thing, but it does tend towards oligopoly, which is why you got to regulate that. So it doesn't. It works until it doesn't. And you got to make sure that free markets exist because that's, because companies simultaneously who operate in free markets don't want them to be because they want to have more control. And it's a balance we all got to make. Oh, this is good. Wow, we need more massive FDI finance, trillions in muni, state, regional authority debt so we can fix all the busted local governments, new free trade regime. President Reyes has outlined his policy plan coming up.
All right. I think that's it for now. But what I heard was, I just to summarize what I heard was this doesn't usually end well.
No, here's the thing, but it doesn't necessarily have to end catastrophically, I guess, Colin. So here's the thing. So we noticed that it wasn't like overnight from the 1960s to today. It wasn't like this was the greatest recession of all time. It happens gradually. We gradually uptick. The problem is we've concentrated very rapidly. And we could deconcentrate rapidly, but what would be the cause of that? And that would be an economic crisis in the United States, a delevering of the market. There's all these other things that could happen. Yeah, the Fed is reloading the cannon to that point. Yeah, we need to be a broader market to offer more deals, more companies, more things, and to make things wealthier, and also build a lot more than we're building for cheaper. It's hard, even here, even in New Mexico. I just had a discussion with somebody who was like, I can't build anything. The city can't afford to maintain a permitter. And so companies that want to build, I have a former student that his family operates a hotel chain. And they're building this hotel. And there's a couple moving factors here. An 81-room hotel cost $12 million a couple years back. Now it costs $14.5 million. Elevator costs have surged. Elevator costs are an amazingly dig up elevator costs and the reasons for them, but they're $1.5 million to install a new elevator, just one of them. And then on top of that, the permitting he has to pay for because the city doesn't have enough people to do it. And so they have to drop 20, 30, 40K each time they bring in and say, hey, can you approve? Is this built up to standard? And I know this is happening all over the country in various capacities. And it's making it very hard. And that calculus is, and he's saying every time, it's like, do we continue to build here or do we build in other places? New Mexico's got we got a lot of California in us, in our DNA. Partially because we're so close to Texas, we have to define ourselves by some other way. So we just gotta, but it's a thing, the thing here. We take all the bad things. We're like zoning. We're like, yeah, right here, let's do it. No building. We're gonna do it. We'll just be like, we're like mini, we're like a cheap version. We're like Fresno. That's our,
I see.
Other questions? What do you guys have? Thank you for sticking around. God, we got 2 different Becky Benders. That's great. Thanks for coming. We got Christopher. I know Christopher from old. That's great. Marcia, of course. Melanie. So great to see you guys here.
New Mexico is Fresno
With
with worse hip hop.
I wish that was
Worse hip-hop.
that's we're up and coming. We've got the hop, not the hip.
There's a I'm looking you up on LinkedIn to share your LinkedIn profile, and there's a Riley White that works at Goldman Sachs. Well,
I
that's
know there's a more
fascinating.
successful Riley White. This is the only Riley White you can afford. This is this one. This is this Riley. I'm free Riley.
Yeah. Well, with that said, then I know we're
Oh
here at the bottom of the second hour. What are your final thoughts then for job seekers as they navigate this next month? I want you to come back and give us a presidential election prediction next month and
Okay,
so
a
forth. And
prediction. You want me to,
yes,
you want me to take a prediction? You're saying you want me to predict the outcome of the presidential election. Oh,
yes, you get a
great.
month though. You get a month less 3 days.
Yeah,
So
really refine my model. Oh, thanks, Chris Lee. Thank you so much, and for putting his in the window too. I'm glad you're back in the same meetings. So to answer Albert's question about this is really interesting. So job market works like this. Upskilling is important. It's not the end of the world. It is tight. So everything you're feeling is valid in this market. Differentiate yourself different ways. I say this over and over again. Write an outstanding cover letter. Show your vulnerabilities if you can. I know it's privileged that some people can and some people can't, but at the same time, feel comfortable doing so in a way that tells your story as a human being. Tell somebody. And I had this little thing as well. One cool thing, one little knock. I was talking to one of our big wealth manager hirers locally, and they're like, we get stacks of resumes. How do I sort through them? Tell me something interesting on your resume. Make sure if you're the Marin County chess champion from 1997, you put that in there. Make sure that there's some other factor that makes somebody remember your resume at the end of the day. And I'd be comfortable putting in right there at the bottom. Make that a one pager, but put it right there and say, I do this. And it's okay. You snowboard, you ski, you do something crazy. My goal in life is to visit every county in the United States. That's crazy pants. But I'm trying to get there. And I think you have to distinguish yourself in ways people can remember you.
yeah, well,
Don't.
I mean, you also say that we were all Time Magazine Person of the Year in 2006 when their selection was you. So you could always put that on your resume as well.
Yes, Albert, that's right. And they'll be like, ooh, this person, I remember '06. What do you know about '06, kid? You think you
Oh,
know about '06? I'm going to tell you about '06. It was
yeah.
actually great.
So,
'06 was a great.
anything in particular to watch for next month economically? Because we don't have a Fed meeting. We do have a CPI report and a labor report. And so, what do we watch for as we go into the month ahead?
CPI is going to be big. Follow those job numbers. And of course, October.
October.
Historically threatening month for markets. So for one
Hmm.
reason or another, watch out for any market strangeness happening. There's a lot of, depending on how you look at the market variables right now, you could say we're a pricey market. You could say we're a highly concentrated market. Look at how the market performs and if there's any unexpected surprises. Also watch globally, in particular, economic data. There's been refinement around some questions and political concerns around the China situation. Europe, of course, varying levels of interest. We got Mario Draghi proposing a fantastic plan with the exception that it requires like an $800 billion euro investment. There's no political will for in the Eurozone. The
Hmm.
economy is something that we share globally. Keep your eyes open to everything around the world. A rising tide does lift all boats, so keep that in mind. So we can't carry on the economy, particularly since we trade with the economy. And we want our trading partners to also want to buy our stuff too.
Mm. Got it. Well, that's good
Yeah,
to know. And Aaron
that's
here is predicting a 25 basis point cut here by the Fed in October ahead of their November meeting. So that's something to look forward to as well.
I like hearing
I've
that.
also dropped the link for next month's event into the chat here. So we are going to be back here on Wednesday, October 23rd at 5 o'clock, leading up to really the election, the next Fed rate cut, and so much more. So feel free to sign up and join us then. Until then, I will be sending breaking news emails for everything that happens between now and then, as you've been getting. We also wish you the best as you navigate your job search and everything in between. And don't forget to send in your questions either, which Dr. White will answer in our next webinar. Until next month or until the next webinar that you join us for, we wish you a very wonderful Thursday evening, wherever you may be, and we will see you all soon. Thanks.